Welcome back everyone to the third chapter. Today what we are going to discuss is the difference between accounting profit and tax profit. First we will discuss what is accounting profit and how we will derive from accounting profit to tax profit. This is what we are going to discuss in the today's session. Before starting, let me give you a very broad definition of corporate tax, and we will break it down the definition, which will cover the entire tax laws and regulation. And once we understood the definitions, each concepts what we are discussing, then you can make sure that you have a good grip on the UAE corporate tax law. Now, how I am going to define corporate tax? Corporate tax is payable on taxable income. Corporate tax is payable on taxable income by taxable persons. By taxable person according to the tax period as per the prescribed tax rate. Prescribed tax rate. Now, from this definition, we are going to pick four concepts. First one is taxable income. Second one is taxable person. Third one is tax period. Fourth one is tax rate. This is what the definition of corporate tax means. Any business who is paying corporate tax on their taxable income. Who will pay corporate tax on taxable income? Taxable person. Taxable person means who is liable to pay corporate tax. And on what basis they are going to pay? They are going to pay, or they are going to calculate their corporate tax according to the tax period. Every business has a particular tax period, and on what basis or what rate they are going to use as per the prescribed tax rate. This is the whole four concepts. Now, out of these four concepts, we will revisit again on this definition as and when we discuss each concepts what we have discussed right now in the definition. Now, let's take first taxable income. What is taxable income? Taxable income means the income where a business or a company should pay corporate tax in UAE. That means a business, when they make their year-end accounting, how they will be doing accounting? Obviously, they are going to calculate their revenue and they are going to minus their expense and they will get profit. This profit is called accounting profit, which you all know, like how when we are making the profit and loss account. As you all know, the taxes applicable on businesses in general, it is 375,000 dirhams, 0%, and above 375,000 dirhams, 9%. Is this 9% tax or the 0% threshold is calculating based on the accounting profit? Answer is no. It is calculating based on the taxable income. Now, we need to derive from our profit and loss account balance how much is our taxable income. How it is getting derived, that is what we are going to discuss in today's session. First, let me give an understanding to you. There is a ministerial decision, which is Ministerial Decision 114 of 2023. And this particular ministerial decision explained which accounting standard every business should follow in UAE for the corporate tax purpose. Now, this ministerial decision explained that UAE is following the accounting standard, which is IFRS. What is IFRS? It is a reporting standard which is called International Financial Reporting Standard. International Financial Reporting Standard. It is nothing but a standard in which the business should prepare their profit and loss account. Most of the countries in the world following IFRS as their accounting standard. There are deviations also. If you take a country like US is following a different accounting standard called US GAAP. India is following accounting standard which is Ind AS. So in India it is Ind AS, Indian Accounting Standard. US it is US GAAP. However, most of the countries in the world are following IFRS. IFRS is explaining, like when you are dealing with your financial statement, how you need to book certain items. No, not certain items, all the items. Now, for example, I will give a couple of IFRS standards. IFRS 15 is talking when a business gets revenue, how the revenue should be booked, on what basis the revenue should be booked. They define 5-step model, and in each step we need to understand, identify the contract, identify what you have committed to your customer, then break it down. Then as and when you fulfill your obligation to your customer, you need to book revenue. This is what explained in IFRS 15. There is an accounting standard, IAS 2. IAS 2 is talking about inventory. If a business has inventory, stock, how they need to book. It is explained they need to book cost or net realizable value, whichever is lower. So IFRS is nothing but a reporting standard which a business should prepare their profit and loss account and balance sheet. And through Ministerial Decision 114 of 2023, UAE Ministry of Finance clarified that in UAE, business should follow IFRS as the accounting standard. Further, in Ministerial Decision, it is explained that if a business is making above 50 million AED in a year as a revenue, they should follow IFRS, full IFRS. Then, if a business who is making below 50 million AED in revenue, they can follow IFRS for SME. It's nothing but a simpler version of IFRS. It's IFRS itself, when it cannot be not able to follow by small businesses. So there is a simpler version of IFRS. If a business is making below 50 million dirhams, they can choose for the IFRS for SME. Any business who is making revenue below AED 3 million in a year, they can either prepare the books in the cash basis or accrual basis. Now, what is cash basis, what is accrual basis? I will give an example. Let's say your business got a revenue of AED 120,000 dirham for an annual contract. You got a contract, and this contract is for 1 year, and you got the money 120,000 dirhams. As per cash basis, if you are making your accounts as per cash basis, this 120,000 dirhams you will consider as revenue on the day you received. On the day you received, you will consider it as a revenue. Whereas if you are following accrual basis of accounting, you will see that, okay, this revenue I got today is not for the not for the 1 day or 1 month. The revenue I received, and I need to do my services over a period of 12 months. So what you are going to do, you are going to divide 120,000 dirhams with 12 months, and you are going to book each month AED 10,000 dirham. So in accrual, you are going to book your income and expenses as and when it is due, especially when it comes to the long-term contracts. Whereas in cash basis, you are going to book the revenue the day you receive the money. For businesses who are making below 3 million dirhams, they can either follow cash basis of accounting or they can follow accrual basis of accounting. This is also explained in Ministerial Decision Number 114 of 2023. Now let's discuss. We know like how we are arriving accounting profit, which is basically revenue minus expense, and how we need to derive our accounting profit using the accounting standard. Accounting standard is IFRS. Above 50 million dirhams must follow full IFRS. Below 50 million dirhams, they have a choice. They have a choice. Either they can do full IFRS or a simpler version of IFRS, which is IFRS for SME. Below 3 million dirhams, they can either go for cash basis of accounting or they can go for accrual basis of accounting. Now let's discuss on taxable income. How a business should arrive taxable income from accounting income or accounting profit. So when I am telling income in the tax law, income is equal to profit. So please don't get confused when I am telling income, I am referring revenue. Revenue either it will be defined or explained as revenue or as turnover. Income will be always income or profit. So when I am telling taxable income, I am referring that taxable profit. When I am telling taxable revenue, that means it is revenue, or it's not considered as profit. Now taxable income or taxable profit, we need to determine from the accounting profit using 8 adjustments. There are 8 adjustments specified in the corporate tax law, and using these 8 adjustments, we need to derive our taxable profit. What is the first adjustment? First adjustment is exempt income. Exempt income is explained in Article 27 of Corporate Tax Law. Corporate Tax Law explained that certain incomes are exempted. That means if you have accounting profit and in that accounting profit there are certain income which are exempted from corporate tax law, you can remove it. There are mainly 4 exempt income which we will discuss in detail. We will have a separate chapter for exempt income. One is local dividend, means any UAE company is getting dividend from another UAE company. Second one is participation exemption. Participation exemption is when a UAE company is getting dividend from foreign country or getting capital gain when they sell the shares. And the third category is foreign business who are into international aircraft or shipping. This exempt income is mainly based on the reciprocity treatment between UAE and other countries. I will give an example to you. UAE is telling that, okay, if an Indian airline, any Indian airline, let's take an example, Indigo, is coming to UAE and picking passengers from UAE and taking it back and doing shuttle services. UAE will not tax Indigo if India is telling that India will not tax Emirates. So it's a reciprocal contract. If that reciprocal contract is honored by the countries, then UAE told that such companies, such airline companies, no need to pay taxes in UAE. These are exempt income, which is the first adjustment we need to do to derive from our accounting profit to tax profit. We will discuss it in detail. Second adjustment is unrealized gain or loss if elected. Unrealized gain or loss, again what it is, unrealized gain or loss. Let's say a company bought a property, a real estate property. They bought it in 2024 and they are not selling this property. The property value is increasing year on year. Every year the property value is increasing. When the property value is increasing, they may be including the increased value in their accounts. Let's say they are using a revaluation model. What is revaluation model? Every year they will see what is the assets, what are the assets the company have, and they will see what is the market value as on today, and they will book the market value. So what is going to happen if, let's say, they bought a property for 1 million in 2024. Now they are closing the books of 2025. They are using a revaluation model. In 2025, 31st December, the property value is 1.25 million on 2025. Have they sold this property? No, the property is still with them. Now this 250,000 dirhams is a unrealized gain. Have they sold this thing? No, they have not sold. It is still in their books only, and but the value of the property is increased. Now this 250,000 dirhams, do they require to pay taxes? If they have elected that we will not pay taxes on our unrealized gain, then they do not require to pay taxes on unrealized gain. So this is the second adjustment. Third adjustment, income from group companies. This is mainly related to tax group. Again, all these things what we are discussing, you can, in short, like, I don't need to tell you this every time. I'll give a bottom line disclaimer. What we are going to do here, it is around 8 to 10 chapters. In the first 8 to 10 chapters, we are setting a foundation. And 11th chapter on, we will be going back to all concepts what we have so far discussed in detail, each and everything. Tax group, which we are going to discuss now. We will have at least 2 chapters on tax group. Exempt income, we will have 1 or 2 chapters exclusively on exempt income. We will have a separate chapter for unrealized gain, how to calculate all these things. So everything will be covered again in detail. Right now what we are doing is we are just setting a plot so that you are understanding the basic concepts. So what is tax group? Tax group means company A, company B, they are applying to Federal Tax Authority that we want to create both these companies as a group, and we want only one tax registration number, one TRN. Now if they have one tax registration number, they are going to do one filing, one tax filing, correct? So any transaction happening between these companies, let's say company A is selling the goods to company B. So for company A it's a revenue, company B it's a purchase. That what is going to happen? It is going to be knocked off, the purchase and sales. So if there is a tax group, the income from group companies need to be excluded while calculating the taxable income. If you are seeing company A's books, what will be there? There will be a sale income because they sold the goods to company B. If you see company B's books, you will see a purchase. Now when it comes to corporate tax, this income on expenses or the purchases will not be considered while calculating the taxable income. Why? Because they are filing single tax return. It will be knocked off. This is the third adjustment. And fourth adjustment is non-deductible expenditure, which is explained in Article 33. Certain expenses which may be considered as expenses for your business purpose, but for tax purpose, it is not considered as an expense. I will give an example to you. Fines. If a company is paying some fines, in company's books it will show as an expense, right? But for tax purpose, the authority told, no, you cannot consider fine as an expense. You need to disregard these expenses. And further, it is explained that if the business has any entertainment expense, entertainment expense means the business is keeping some kind of events for the customers or suppliers, and they are spending money for that. In IFRS point of view, yes, it is your business expense. You can consider it in your books. But tax law is telling, no, entertainment expense is not fully allowed. Entertainment expense is allowed only 50%. One last example I will give to you, which is donations and gifts. If a business is giving any donation or gifts, it is disallowed. In donation, the authority told, if you are giving any donation to approved charitable institution or any approved institution, then it is allowed. So there is a separate cabinet decision. In that cabinet decision, there is a list of organization which are approved, and if any business is giving any charitable charity or donation to those organization, it is allowed. Otherwise, if the business is telling like, okay, I gifted these things to my employees, I have done a charity to Mr. A, or like, to someone they have given some charity, the authority told no, it is not considered as an expense for tax purpose. You need to disregard this. And fifth one is transfer with related party and connected person. Who is related party, who is connected person? Related party means, think of a situation, you have two companies, company A, company B. Now, both companies are owned by you. That means you can control the price of transaction between these two companies. Let's say company A is providing a service to company B. Both companies are owned by you. You can decide that, okay, company A will not charge anything for this particular service, or company A is going to charge 100,000 dirham for this particular service, where the market value is only 1,000 dirhams. So you as a person has a control over the pricing when there is a transaction happening between two companies. That means company A and company B are called related party. This is the first concept. Second concept is connected person. Connected person means any business has owner or officer. Officer can be manager, director, CEO, CFO, COO. It can be anyone who is on the senior level, or relative of owner / officer. These are the three categories of people who come under the definition of connected person. Now, why it is important? In UAE, if you remember, we discussed in the previous chapter that the Cabinet Decision 49 of 2023 is published, and Cabinet Decision 49 told natural person will be subject to corporate tax if the business income is more than 1 million dirhams, and while calculating the 1 million dirhams, you are going to exclude three things. First thing is wages. That means if an individual who is getting wages, that wages is not subject to corporate tax. If in UAE, if the salary or wages is not taxed, every business will straightforward think that, okay, let me take the entire profit as tax and make my company on losses so that I don't need to pay taxes. Now think of a situation, UAE, it is not there just for example purpose I am telling. Or I will give a real example to you. You take an example country, Singapore. Singapore has 17% corporate tax. Singapore has 23% income tax. Now, someone from Singapore, and they told once the company paid corporate tax, dividend, no tax. Now someone from Singapore, what they will do, will they take dividend after paying 17% corporate tax, or will they pay 23% income tax by way of taking salary? They obviously will go for 17% corporate tax they will pay, they will not take any salary, and after paying 17% corporate tax they will take dividend. But now in UAE told if you take salary, there is no corporate tax applicable on that. Here comes the concept of connected person. If you are a connected person of the business, your salary need to be as per the market value. And you need to document it. And this documentation, entire thing is called transfer pricing. Deciding in which price or what should be the salary as per the market value the owner or senior management can take, and documenting it. This document is called transfer pricing document. The same goes for related party also, which I explained to you previously. If there is a common control in two companies and that two companies are considered as related party companies, when they do transaction, they also should deal in a market value. When you think inside UAE, it may not make sense to you, but I will give another example to you. Company A in UK, company B in UAE. UK, let's say the corporate tax rate is 23%, and in UAE the corporate tax rate is 9%. This both companies are owned by Mr. A. So what Mr. A is thinking that I will invoice from my company B to company A for some services, and instead of charging 100 AED, I am going to charge 10,000 AED. Why he wants to do it? When UK company paying UAE company this 10,000 AED, in UK it is considered as expense, which will obviously reduce their corporate tax, and the corporate tax rate is 23%. Versus in UAE, even if we bring the income to UAE may be taxing, or even if the company is paying the corporate tax, company is paying only 9%. So ultimately that company is saving 14% tax. To avoid this practice, again the concept came, no, both the companies, UK company and UAE company, they are related party, and when they are dealing their business transaction, because there is a common control, the transaction need to be dealt in arm's length value, which is called market value. So what is arm's length? Arm's length, it's a technical term, but what does that mean is that if your arm has a length, like when you keep your arm straight, you are finding your third party customer. The same length you need to keep for your own controlled companies also. That means in the example what we have given, that company B generally providing this service to third party for 100 dirhams. That means that is the arm's length value. That is the amount they are charging for the third parties. When they charge for their own companies, they should keep the same price, the same arm's length value they need to keep. You can call it market value, arm's length value, both are fine. Arm's length is more technical and professional word. The same way we discussed on connected person, if the connected person is getting some benefits from the company, it need to be at market value or arm's length value. So this is the fifth adjustment. And why this adjustment is there? I'll just quickly explain to you. In the same example, company B was supposed to get 100 dirham. 100 dirham is the ALP, arm's length price. How much they got? 10,000 dirhams. So this 10,000 dirham they will show in their book as revenue. Correct? When they calculate the corporate tax, they need to reduce their revenue 9,900 AED. They need to reduce the revenue because this 9,900 is a non-arm's length value. Reciprocally, in UK, they should consider only 100 dirham as expense. This is mainly this concept of transfer pricing is mainly coming in the international transactions. Again, we will discuss it in detail. How much ever I am telling, I am not going to repeat it, but maybe I am getting a feeling that you may be thinking it's so complicated, but all this concept we are going to discuss again. Now the sixth adjustment from the UAE Corporate Tax Law, transfer of losses where 75% ownership is common. What is this? If a company, let's say again company A, company B, both are owned by Mr. A 100%. That means both the company, Mr. A is owning more than 75%. Company A in 2025 got loss. Company B got profit. Now the corporate tax law is telling that when you are calculating, let's say you are checking the calculating the tax for company B, that means company B is showing as per books profit. Tax law is telling that if one person has more than one company and in both company that particular person has more than 75% shares, then company A loss can be transferred to company B's profit and it can set off. So in your books you are showing it's showing a profit, but in taxable income when you are calculating what you are going to transfer loss of company B to company A, and then let's say you have a profit of 100 and you are transferring loss of 50, that means your taxable income is 50. So any transfer of losses is there, that also you need to take into consideration when you are calculating your taxable income. Seventh one, tax incentives and reliefs. Tax incentives and reliefs. As on today, there is no tax incentives or reliefs announced. In future, when the authority announce any incentives or relief, that you are going to take into consideration. You are going to minus this incentive from your accounting profit to derive your tax profit. This is the seventh adjustment. And eighth is any other adjustment which Ministry of Finance decides through a ministerial decision. So these are the 8 adjustments. Now you have accounting profit, and from this accounting profit you are calculating your tax profit. While calculating your tax profit, you need to make 8 adjustments. Adjustment number 1, you need to remove the exempt income. If any of your income which is there in your books which is exempted from UAE corporate tax, you need to remove that. Second thing, if you have elected that my company will pay taxes only when the profit is realized and you have any unrealized gain or loss, that means you need to adjust that one. That is the second one. Third one, income from group company. If there is a tax group created and any transaction happening between the group company need to be removed. Fourth thing, non-deductible expenditure. Certain expenditures will be shown in the books, but as per the corporate tax law, that may be not allowed or partially allowed. We discuss fines are not allowed, entertainment expenses 50% allowed, donations, certain donations are allowed, certain donations are not allowed, like that. There are a list of non-deductible expenditure. Then fifth thing, any transaction happening between related party and connected person, and you need to adjust it if there is a non-arm's length value in your books. If your books are as per arm's length, then no need to adjust, but if there is any non-arm's length or non-market value is there in your books, that need to be adjusted. Sixth thing, any loss you are transferring from a group company, like if there is a 75% ownership and you are transferring the loss from company A to company B, then that adjustment need to be made. This transfer of losses is explained in Article 39. And seventh thing, when the authority announce any incentives or relief, that also you can adjust in your books to arrive the taxable income, and any other adjustment which Ministry of Finance will be announcing in future. Now let's make a example calculation so that all these things we will be covering. We got a profit and loss account, and the profit and loss account is telling that okay, the company has 1 million dirhams revenue. Company has expenses 700,000 dirhams. That means the company has a profit of 300,000 dirhams as a profit. This profit is accounting profit. And how they need to arrive this accounting profit? Using the accounting standard. What is the accounting standard? IFRS. Now once we get the accounting profit, from here we are starting the tax calculation. Let's say in this 700,000 expenses, there is a fine the company has paid. And how much fine they have paid? They have paid 50,000 fine. Is fine is allowed as per UAE Corporate Tax Law? No. That means we need to add back 50,000 dirham fine, which is already included in the expenses. Then comes entertainment expense. In this 700,000 dirhams, let's assume there is 100,000 dirham the company spent for entertainment expenses. How much can be claimed? So the total is 100,000. How much is disallowed? 50%. Only 50% is allowed. That means they are going to add back again 50,000 dirhams to their books. Now these are the two adjustments. Let's assume, to make it simple, these are the two adjustments. That means their revenue accounting profit is 300,000 dirham. Out of their total 700,000 dirham, two expenses were either one was not allowed, one was partially allowed. Now when we add back, their income become 400,000, and this is called taxable income. CT is applicable on taxable income, and how we need to work out? First we need to see up to 375,000 dirham 0, above 375,000 dirham 9%. How much it will be? From 400,000, first 375,000 is not taxed, then rest 25,000 dirhams is taxed at 9%. How much will be the taxes? 2250. This is how, in short, the corporate tax calculation need to be done. First we need to prepare the books, make the adjustment, arrive at the taxable income, calculate the tax and pay the taxes. This is how it need to be done. So with this we will stop, we will end today's session. I am going to post 3 questions which is relating to today's discussion, and please make sure that you are answering for those questions. We'll see in the next session. Till then, bye-bye.